Wanted to show you some of the highlights of a couple papers that I have posted in D2L. All right, so this is basically a survey of managers and financial managers at public companies. And basically what they wanted to figure out is, how do they actually make decisions within the company? Right, so this paper basically just asked them, what do you do in order to make investment decisions, right? That's fundamentally the most important decision that companies are going to be making. What they found is the vast majority not only use multiple methods, but use internal rate of return and NPV, right? Roughly 75% of executives rely on those two metrics, right? So those examples that we were going over there, they got relatively complicated towards the end there. But part of the reason for that is they are used. If you're going to work in the field of finance, there's a high chance that you're going to be dealing with some sort of valuation model. And very often they go to rely on NPV. And the next one we'll see that they're doing that more so later in the future. And when calculating the cost of capital, most of them are relying on the capital asset pricing model. Just over 70% are using that. But again, right, we can see all this adds up to more than 100%. So we know that they are using multiple methods of multiple ways of calculating the returns in capital, the cost of equity, right? So these things that we're going over in class, right, they are just classroom examples, but they are directly applicable to things that you'll be using within the field. The vast majority of financial managers are using these models. And just a few years, I think it was 8 years after this was published, they put out the surveys again. This time they got a little more qualitative as well, including some, some of the qualitative decisions that people tend to make and have a bias towards using. But still, overall, NPV is the most common and most relied upon method for determining how to allocate capital. And so this is that other paper that I have posted in there, the Graham 2010. All right, so what we are doing are just academic examples so far, but they're directly applicable to what you'll be using in the field. The vast majority of financial managers are using it. I haven't found one updated more recent times. I've got to find a survey that looks at it, but the couple of surveys that they did over this roughly decade period showed that NPV was increasingly important relative to the other methods of making decisions. All right, so it is a complicated metric. Totally understand that, but it is vital to understand. So make sure that when you're going through the problem set and the practice problems that are posted on D2L, that you try to go through them enough that you start to become comfortable with putting it together. Right, at the end of the day, there's 4 steps we're following. Set up the time periods, allocate the cash flows. As we saw last time, calculating those cash flows can get really complicated. But allocate cash flows in their appropriate time period. Discount the cash flows, right? Time value of money is vitally important. Time is one of the fundamental factors in our field. And if we don't adjust for the timing of cash flows, then we're not getting an equivalent basis to judge the value of those cash flows, right? $1 today doesn't get us the same as $1 even a year ago, let alone 100 years ago, right? Money is worth a different amount across time. So it's important that we adjust for time differences. After we take the present or future values of everything we're evaluating, we add it all up. Final step, time periods, cash flows, discounts, sum it all up. Same 4 steps. The inputs can get complicated, absolutely. But as long as you follow those 4 steps, you're at least heading in the right direction for getting some sort of valid valuation of an asset that you're going to be looking at, right? And if you started looking through Capital IQ, that's basically all that model is doing, right? It's much more complicated because there's more information being drawn in there, but it's still relying on those 4 steps. At the top of it, you see information about putting together the discount rate, getting the WACC that's being applied to discount the company's cash flows. Further down, you see cash flows forecasted into the future. Then at the bottom, you see all of them discounted back and added up in order to get the overall value of the firm. Right? But as you can see, looking at Capital IQ, there's a lot of information that can be broken apart in order to get the discount rate, in order to get the cash flows in each year. All right, so starter class, we're going to be talking a little bit more about calculating those cash flows and giving an example with a company. Any questions before we get started? All right, so in our sheet here, I've copied over some financial statements for Walmart. A little bit dated at this time, but we have cash flow statement, the balance sheet, the income statement, and I also downloaded historical data on the market and the risk-free rate, right? And what are we going to use this information for between the market rate of return and the risk-free rate of return?
Calculating capital.
Yep, calculating the cost of capital. This is what we're going to be using to get the cost of equity, like we just showed in that survey, CAPM, right? That's how most people go about trying to find the cost of equity. That's what we're going to be using this information for. All right, so we have all of that available to us. So let's get going. All right, so one of the things, and this does irk a lot of people in the field, but in my perspective, getting straight to the bottom line is pretty important, right? So there's a lot of information in financial statement, but if we think about a company in perpetuity, what components of the company are relevant to its value in perpetuity? And in order to answer this question, just think of a growing perpetuity formula. What are the three inputs to that formula, to that equation?
Cash flows, growth, and your return.
Yep, the cash flows, right? That's in the numerator. That's what we're going to be dividing everything by. So the cash flows are fundamentally important to any asset, right? The value of anything is the expected discounted future cash flows of that asset. So if we're valuing something in perpetuity, obviously the cash flows that asset is going to be generating are vital. All right, so cash flows are but most important. We can get straight to the cash flows by going down the bottom of the cash flow statement. Sometimes it'll be included. Yeah, that was the cash flow statement that I started with over here. All right, so that's straight to the bottom line, right? Cash flows are what matter, and anything that affects the cash flows, whether directly by calculating free cash flow or indirectly and over time. All right, so can someone else tell me what are the inputs to cash flow? What's the information we need to calculate free cash flow?
Revenue minus cost of goods sold, then EBITDA, or yeah.
Close. So if you're going to use the depreciation tax shield method, which I think you're starting off with, right? So we start with revenue, then we subtract out cost of goods sold. So the cost immediately associated with generating that revenue. Then there's one other really important top end cost that we have to get. Right, so we have our variable costs and our, what was that?
CapEx?
So yes, that
Fixed
is.
cost.
What was that?
Oh, sorry, I talked over somebody. Fixed cost.
Fixed costs, exactly. Selling, general, and administrative. Right. So the top end costs are going to be the variable cost or cost of goods sold, and the fixed cost, selling, general, and administrative. All right. So those are our first three, but we also have to get them net of
Tax?
Change in
Yes.
working capital.
Yes, net of tax. Oh, actually, yeah, great point. Change in net working capital is also going to be one of the next items taken out. Yeah, change in net working capital, right? In other words, the short-term working capital companies use to fund their revenues. The current assets, current liabilities that they use to fund their revenues. Exactly. And someone mentioned earlier, capital expenditures. Yep, and capital expenditures is the wrap up there. Or actually, I'm getting ahead of myself. There's one other item. After capital expenditures, there's one thing that we have to add back now.
Depreciation.
Depreciation,
Yeah.
yes. But if we're using the depreciation tax shield method, there's a specific way we re-include depreciation. What is that?
It's net of tax. So depreciation times tax.
Yes, exactly. Because what's going on here is companies aren't actually paying cash out of pocket for their depreciation expense. It's just an accounting item that's reducing their taxable income. So when companies are reducing their taxable income, they're avoiding cash outflows by the amount of their depreciation times their tax rate. Right? So again, the depreciation tax shield method calculating free cash flow, we have net of tax revenue, net of tax costs of goods sold, net of tax selling, general, administrative. add back our depreciation tax shields, net out our changes in net working capital, net out capital expenditures. Oftentimes, though, companies may use different methods for calculating free cash flow. Interestingly, there's a lot of discretion in calculating cash flow. And we're actually going to go look at how Walmart calculates their free cash flow. So let's go over to SEC filings. Go to their annual report. All right. I forgot to look this up ahead of time to get specifically where it is mentioned. Cash flow. There we go. So I have a very simple definition of cash flow: net cash provided by operating activities minus CapEx. Right? And like they say up above here, right? Companies have discretion for defining how they calculate cash flow. So there are many different methods for calculating cash flow. One of the most common methods that we see in practice, the depreciation tax shield we just spoke about, is in many ways the best metric because it is explicitly showing all of the relevant items in calculating free cash flow. And the more information we can present in our cash flow tables, the quicker we can see where maybe issues in our forecast are. So when we explicitly show everything going into free cash flow, that's great. But in practice, right, people have a tendency not to do necessarily what's best, but maybe what's easiest, right? Or what's most readily available. And oftentimes that's going to be the bottom-up approach that we see companies using. And that's going to be starting with net income, adding back depreciation, and then netting out change net working capital and capital expenditures. So companies have a lot of discretion in how they're calculating that. All right, so like I said, I like to get straight to the bottom line. And as we recall, the growing perpetuity formula, the three things that are relevant to a company's value are the expected cash flows it's generating, the discount rate that we're applying to those cash flows, and the growth rate of those cash flows. Those three things over the long run are by far the most important things in determining an asset's value and determining a company's value. All right, so we're going to go ahead here and we're going to look at the company's cash flow growth. So already have total cash flow growth over this time period. Now we're going to just calculate that for each year. So we're going to calculate.
Hi, Dr. Jameson, I got a question.
Yes, sure.
So why are you using the unlevered free cash flow, not the levered?
So you can use either depending on what method you use to evaluate the discount rate. So the unlevered free cash flow is the overall cash flow that the company is generating. So we're going to be using the WACC as our discount rate. Levered cash flow is cash flow that's attributable directly to shareholders. And if we're evaluating that, then we would be using just the cost of equity as our discount rate.
Okay.
But we're going to be looking at the overall cash flow the company is going to be generating.
Okay.
Good
Can
question.
you explain the difference between the levered and the unlevered?
Yeah, so net debt. So basically the only difference between these two is adjusting for debt issuance. So that's why you typically see levered being lower than unlevered free cash flow.
Okay, thank you.
Right, but again, this is attributable to shareholders, so you'd use the cost of equity. This is attributable to the overall firm, all capital providers, including debt holders. So we're going to be using the company's WACC, the overall cost of capital to the firm. All right, so even though we're dealing with a relatively large and established company, we can still see that there's a significant amount of volatility in their cash flow growth over this time period. Right, so part of the reasons we want to take an average over time is year to year, and the shorter time periods we look at, the more volatile things tend to be. So taking averages across time gives a little bit better sense of what the average cash flow growth. And as we see here, the average annual cash flow growth is relatively small, 2.33% per year. All right, so we have the growth rate that we can be using here. Now we've got to get the rest of the information in here. All right, so we're going to get the cost of debt. That's a note here states. We're going to be using the company's financial statement over here. So let's get the cash that they have available in the last year. Their total debt. And we're going to get the net debt. Right, so this is functionally the debt outstanding for the firm that the company doesn't have cash immediately available to pay for it. And now we're going to get the cost of debt. So last class we downloaded Damodaran's cost of capital sheet. All right, we're dealing with a retailing company. It's a retail general. Now we're going to look at the company's cost of debt over here. The zoom is in the way, I can't see it. .16%. So if we assume that Damodaran's cost of debt is an adequate reflection of the company's cost of debt, then this is something we can use. We can also look at the company's financial statements to see what their cost of debt. We can also look at the interest rate directly on companies' financial statements. All right, so Capital IQ, the default method used in that model is to take the last 5 issues of a company and get their weighted average cost of debt on those issues. Right, but like I mentioned, there's a couple of problems with this. Right, so if they only issue like a single type of term to maturity bond, then you're biasing towards whatever that is, right? So for example, if a company issues only short-term debt, right? In this case, we see that they have a pretty wide range here on maturity. But if they happen to have only released short-term maturity debt over a given time period, then you're biasing that company's cost of debt towards short-term maturity. On the flip side, if they issued relatively long-term maturities, right, basically above 10 years, then you're biasing towards higher cost of debt. So it's important that if you think using the company's last 5 issues, in other words, Capital IQ's default option, it's important to go into the company's financial statement and actually look at what are the most recent issues for the cost of debt. Do they actually show a decent distribution in terms of term to maturity? And in this case with Walmart, it looks like actually they do. Right. So one option, if we wanted to use Walmart's cost of debt is to take the weighted average of interest rates on the last 5 issues, because they actually do reflect a decent distribution of term to maturity. We have short-term debt, midterm debt, and long-term debt issued as well. All right, so we have a couple options available to us, but if we're suspicious of just taking only the last 5 options, then maybe we can use the cost of debt for the industry overall. Oh, I should double check. Okay, so we don't have the after-tax cost of debt just yet. All right, and so here's another difference that comes in, is looking at the tax rate. All right, so a couple interesting things have happened with the tax rate over the last 5 years that are very important to keep in mind with your valuation specifically. There have been 2 changes in the top marginal tax rate that companies are experiencing. Right? They dropped down to, I think it was 21% under the Trump administration, and then increased to, I think it was 27% under the Biden. Right, so we have different tax regimes that companies have faced within the sample period that you're getting the information on. So very important that you keep that in mind, that they were facing 3 different top marginal tax rates in the time period you're getting information on that company. But keep in mind, when we're putting a valuation together, we are only concerned with the future. Right? It's only about that asset's expected future performance that matters to its value today. Right, so in that case, it's very important that you're using the most recent tax rate applicable to the company's cash flows in order to project their future tax rate. Right, so companies do often use methods to reduce their taxable income, which, if they get their income low enough, is going to reduce the marginal tax rate that they're paying on there. And so there's a couple of things we can do here. We can just assume companies are going to pay their top marginal tax rate. So if we make that assumption, basically we're being very conservative in the value that this is going to have on the cash flows. But on the flip side, it's also giving more weight to the net of tax cost of debt that we're going to be dealing with here. Okay. So it's going to be up to you to decide which tax rate you think is going to be familiar. If the company you're looking at has something significantly lower than the marginal tax rate applicable to the firm, or the top end marginal tax rate applicable to the firm, then go and see maybe what is going on there. Right? Is the company doing something to actively manage, or are they losing money? Are they unprofitable? Right, so now we're going to get some information on the company shares. So we have to get the number of shares outstanding, the price, the market cap, and the beta. We have market information already calculated. Let's see. Oh, you know what? I should use, that was monthly, I just realized. So looking at the farmer friends, we have annual. Get the market. Never forget to save it. All right. So average over the time period was about 12.1%. So I want you to also try to make an argument for what you think the best time period and what the best resource is for calculating the cost of equity, right? And there's a few options that we had spoken about here. The Farmer French data set, this captures the entire universe of publicly listed companies in the United States. Right, so we have market information on their average rate of return every year. And we also have the risk-free rate, right? The 3-month treasury bill in this case. So over the last, what is the time period? I think it's yeah, almost 100 years now. So we're at about 95 years. It's averaged about 12.17% per year. But, and this is what Capital IQ is doing. The last decade has seen much higher average returns. Right, so again, with valuations being forward-looking, it's important that we keep in mind the differences between the long run average rate of return and the average that is the default option in Capital IQ. So by using just the last decade, right, we see that we're getting an average rate of return that is significantly higher than we're seeing over the last 100 years overall. Right, there are some people that may argue that maybe this is just a regime change in the way price valuations work. Right, that's actually one of my family members works in the field very closely with valuation and project management, and we'll often get into debates about if there was a regime change in the general valuation of assets over time. He is of the opinion that right, we just should expect higher future returns given the valuations that some companies have had, meaning that they're expecting to be generating a lot of value over the long run. So under that idea, then relying on the last decade of data might make sense, right? If you suspect that there is actually a fundamental regime change, that valuations are accurate and therefore moving forward, we should expect higher rates of return, then relying on that last decade is going to make sense. But then on the flip side, there's also the argument that, well, because we've had these higher rates of returns, there's not much else left for companies to invest in, right? There's likely overextended themselves on their investments. This is something that we saw at the end of the conglomerate era. It's what we saw at the end of the tech bubble era. And maybe there's some sort of other asset bubble going on that is resulting in these high average rates of returns that moving forward, we should expect lower average rates of returns, right? And that's something that we've seen this year, right? The rate of return on the market is not 15% over this year. So, right, there's different arguments that can be made on what we take as the market rate of return and what time period we should be looking at. So just for the sake of this example, we're going to use this 12% as our market rate of return. Get the risk-free rate. Risk-free rate is an interesting difference here as well, right? Because the difference between market rates of return and the risk-free rate is that there is an institution that determines what the risk-free rate is, right? The Federal Reserve. So over the last decade or so, if we were to look at that average, we see that we have the exact opposite problem relative to the stock market, right? If we look at the average risk-free rate over the last decade, it's relatively a fraction of the cost relative to the average cost of, or the average risk-free rate over the last century, right? And we can see exactly when that comes into play, right? When the Federal Reserve stepped in to help reduce the cost of debt when we were in the financial crisis, right? Immediately dropping the cost of borrowing, right? So in a situation like this, maybe it might make sense to project a lower risk-free rate moving forward in the future, with the mindset that the Federal Reserve has control over the risk-free rate, and everything else equal tends to prefer having lower rates. But again, we have something else happening in markets right now that might change the direction of this risk-free rate moving forward in the future, and that's the really high inflation we've been seeing, right? So with that really high inflation rate, the Federal Reserve is acting to help stop that runaway inflation, and they do so by increasing the risk-free rate. So in other words, if we're just using the last 10 years, we know that the Federal Reserve is determined to reduce inflation. So we know that moving forward, the risk-free rate is going to be continuing to increase. So if we're using the last 10 years of risk-free rate, we're ignoring the fact that the Federal Reserve is going to be increasing rates. One other option we have in here. So Dividend is looking at the longer term treasury bond, whereas the Fama French is looking at the shorter term T-bill, right? And that's currently set at 1.5%. Right. So it's also important to think whether the risk-free rate should be based on the shorter term, which is less risky, or the longer term, which based on the term to maturity discussion, right? The further out the bond is being repaid, the further out in the future the principal is being repaid on that bond, the riskier that bond is going to be. Overall, half seems a little bit low. Maybe we can go further back into the future, but ignore rates that are much higher than that. 45, say 35, right? Get an additional 10 years. Right, so it gets us a higher risk-free rate, which is what we should expect moving forward in the future. So let's go ahead and put that. All right, so we have the market information we need for CAPM. Now we're going to have to get specific information for Walmart. When you look up a company's ticker symbol, usually there's going to be free resources available. And then when you click on them, something like Yahoo Finance, Google Finance, immediately on the company summary, you're going to get the information that you're looking for. So we need the number of shares. Actually, we can probably skip that. It's giving us the market cap already. And it's in billions. Taking a little bit of shortcut here just to save some time. All right, so we have the market cap of equity, and we already have a beta calculated for us here, 0.53. Right, larger, older, more stable companies tend to have lower betas, so we should expect them to be a little bit less risky than the overall market. This is a relatively low beta for publicly listed companies. But that will be okay. All right, so we have net debt, we have market cap of equity, beta, and market information. Now we can get our cost of equity. So following through with CAPM, we get the risk-free rate plus the amount of risk times the premium for holding on to that amount of risk. All right. So putting that information together, we're getting an expected cost of equity of 7.7%. One thing I forgot to do here is when you're looking at most values, they're usually putting it in millions or billions. I've got to double check here in millions. The other millions. And so I just took out the zeros to get them in the equivalent values. I both put in millions. All right, so the total value of the firm, right? So because with WACC, it's just relative to the overall market cap, we could have this in, thousands of dollars, which would be difficult in this case with such a large company, millions of dollars like they have in the financial statements, or in the billions of dollars like they have in the market cap of the firm. Right, so we're putting this in millions of dollars. So when we're dealing with scale, really, basically, we're just dropping off zeros that we're rounding off. So the total market value of the firm would be the net debt plus market cap of equity. And now we have everything we need to calculate the WACC. Keep forgetting to cancel that, and it keeps popping up. So to get the WACC, we're going to take the weight of equity times the cost of equity plus the weight of debt times the net of tax cost of debt. All right, So the weighted average cost of capital that we're getting here is 6.5%. All right. So again, what are the three inputs that we need to value this company in perpetuity?
The cash flow, the WACC, and the growth rate.
And the growth rate. Yeah, and we have all that, right? We have cash flows provided for us. Previous year's cash flow. We took the average growth rate and we calculated the WACC. Okay. So, oh, I realized that I had the definition right there as well. Oh, that works out. All right. So we got to get the next period's cash flow, right? Already took place. So we're going to get the next period's forecasted cash flow just using the average cash flow growth rate. And from there, we take the growth adjusted discount rate. So 6.5% minus the growth rate of the firm to get the overall value. Right? Look at the value that we just got using basically a pretty quick napkin math version of valuing a company. Right? So using some historical information, just using the forecasted cash flow relative to the future, right? We need one period going forward. So we're projecting that next period's cash flow divided by the growth adjusted discount rate is getting us a value of the firm of 403 billion. What's the total value of the company outstanding based on this information we just got? It's about 403 billion. Right? So this is one of the fun things to do and play around with valuations is what sort of inputs do we need for it to make sense? Sometimes it happens to work out pretty quickly with just some napkin math. Right? In this case, it happened to work out that way for us. All we did is we used the company's financial statements, readily available information to put together. We took the growth rate of the cash flows, use that growth rate to project the next period cash flow. That gets us the numerator we need in our valuation. Again, using publicly available information, we estimate the company's cost of debt. We use information about the company's debt from their balance sheets. We took a publicly available estimate of the cost of debt for companies in this industry, and we just applied the top line tax rate that the company is going to be exposed to. So that's going to be our debt portion of the cost of debt. And then again, using publicly available information, we got the beta, the market cap, market rate of return, and the risk-free rate. And just using these little estimates to put together our valuation, we were able to forecast the value of the firm that is pretty close to the actual market value of the firm. It's pretty interesting stuff that can be arrived at just with using some freely available resources. And there's a lot of time dedicated to going through and trying to find companies that are significantly undervalued, right? So if you apply a valuation that you're confident in, there are some base assumptions here that don't really work out if we dig into it too much, but this is just for an example's purpose, right? But if we're confident in the model we're applying to a company, then basically what we're looking for are discrepancies between the actual value and the forecasted value we're dealing with, right? The forecasted value that we just applied to this company is pretty much in any definition of a reasonable range around that value within the value of the firm. So in other words, we might think that, okay, maybe this is a fairly valued company based on this model and based on what the price is in the open market. Any questions? All right. Already ended up going through the valuation part of what we're going to be talking about. So the rest of the night, we're going to be talking about dividend policy and capital management. All right, actually, let me go back to that Excel sheet. Free cash flow. All right, so early on in this class, we looked at different scenarios that are really important or that are really relevant to financial managers, right? Dividend policy, capital budgeting, and capital management. All right, so under this base scenario, we just have base forecast valuation for the free cash flow. Right, with dividend policy, we see that there are significant things that companies can do to increase or decrease the company's value given their dividend policy. Right, because it's important to keep in mind that companies' decisions aren't an isolated thing, right? What a company decides to do is going to have an effect on its value, it's going to have an effect on its future performance, right? So in the case of dividend policy, really what we're going to be concerned about is what is the return on invested capital? What's the growth rate within the company relative to the company's weighted average cost of capital? And again, relative to the market rate of return. All right, so with dividend policy, if companies are saving more money for themselves, given that they have valuable return on invested capital, then saving more money within themselves is going to increase the growth rate because they get a high return on investment. And the more that they can reinvest within themselves and reinvest and get that higher rate of return, the higher the value that we're going to see for the company. On the flip side, right, if companies have valuable projects available to them, but rather than reinvest within themselves, they decide to pay out more money to shareholders, they reduce their retention ratio, they're going to have a lower growth rate. Right? Which is interesting, right? Because if we look at the year that they make that decision, cash flows can increase because they're not investing as much. But it's important to keep in mind that what the investments companies make are going to determine their future. Right? And so that's a really interesting difference that we see in the short run on different dividend policies. So in the short run, if we increase the retention ratio, we're going to reduce the company's cash flow because they're investing more money. In other words, right, where do investments show up when calculating free cash flow in our cash flow formula? Right, when we're calculating free cash flow,
Can you repeat
Which-
the question one more time? I'm sorry.
what measure captures investments when we're calculating free cash flow? Investments the company is making in itself.
CapEx?
Like CapEx, exactly. So what happens when we increase CapEx?
And you're increasing your initial investment, so you're investing more
Yeah.
on the front end.
So yeah, so yeah, you're getting to the point we're making here. But what happens to free cash flow
It
in a year that
decreases.
increases CapEx? What was that?
It decreases.
Yeah.
Decreases, exactly. And that's exactly what we're seeing here. So in the short run, a CapEx increase is going to result in a reduction in free cash flow, right? Our base had 10,000 and an increase in the retention ratio reduces that cash flow because we're investing more. But our return on investment is high enough to justify that reinvestment because we're reinvesting within ourselves and we're growing more cash flow. And in perpetuity, it is this growth rate that really is driving a lot of value. Right? A 50% increase in the terminal growth rate of a company, as we can see here, can treble the value of that company. So even though in the short run, we might see a reduction in the free cash flow, if that reduction stems from making value-adding investments like we're seeing in this example here, then it's going to result in a higher overall value for the company. Right? So this company has value-adding investments, so reinvesting more money within itself makes sense because it's going to be increasing the company's value. On the flip side, because they have value-adding investments, if they were to pay out more money to shareholders, if they were to reduce their retention ratio, they're foregoing those investments. And by foregoing those investments, they might increase the cash flow in the short run, but over the long run, and the long run is what matters most to assets in perpetuity, over the long run, as we can see here, they're actually actively reducing the value of the company. So the dividend policy is important. And as we're going to see in a couple of graphs here, there is significant evidence that corresponds to just this basic example that we're looking at here. What companies do with their dividends matter, and it's going to be changing the company's values, and it's going to be changing the values in some interesting ways. And we're going to be talking about that a little bit. All right, capital budgeting. This is something that we went over with calculating NPV and is basically directly related to firm valuation, right? If companies can increase their return on invested capital, which is what they do when we're using NPV, when we're using these capital investments, we're actively searching for investments to increase this company's value. And by doing so, we're going to increase our return on invested capital. The more we can increase our return on invested capital, the more value that we are going to be adding to the company, and the more the value of that company is going to increase. Right. And lastly, we have long-run capital management. In other words, managing a company's cost of capital, increasing or decreasing the WACC. Right? Always remember the inverse relationship between present values and discount rates. WACC is just the present value that we're applying to these assets, to a firm overall. Right. So as we decrease a company's weighted average cost of capital, we're going to be increasing the value of the firm. Conversely, if we increase the company's cost of capital, we decrease the value of the firm. Right, so over the long run, these are all very important decisions that companies have to make, that financial managers are going to largely be responsible for. And it's important to understand how those decisions are going to be affecting the value of the firm. All right. So first question to ask when setting dividend policy is, should a company pay dividends? And if they should be paying dividends, how large should the dividend be? How frequently should those dividends be paid? And there's also some substitutions that can be used in place of dividends to distribute capital, cash or capital value to shareholders. The question when trying to figure out whether or not a company should be paying dividends is fundamentally the return on invested capital relative to the weighted average cost of capital. Right? So if the return on invested capital is greater than the discount rate, then companies would be better off not paying dividends. So that's exactly what we saw in the example we were just looking at. The company had a return on invested capital that's greater than their discount rate. So in other words, every time they reinvest within themselves, they're generating a return that's 2 percentage points greater than their cost of capital. Right? And as we've seen in examples dealing with time value of money, 2 percentage points a year really compounds over time. Right? So optimally, right, if companies were to make this decision as best as possible to maximize value, all that would be considered is the return on invested capital relative to the discount rate. If the return on invested capital in the company is greater than the discount rate, hold on to that money, reinvest it within the company, and that's going to add more value to the company over the long run because they have value adding investments that they can be making. On the flip side, if companies' return on invested capital is lower than their discount rate, investors are going to be better off if they pay dividends. Right? The reason being is we have the exact opposite situation going on. The return on invested capital is less than the discount rate. So every dollar that's invested is actually going to be losing money relative to the discount rate. So investors would be better off if profits are paid out in the form of dividends. And in practice, we do find that especially over time, companies have a tendency to do this. Right? So profitable companies, everything else equal, tend to pay more in dividends. Companies with a lot of investment opportunities, in other words, companies that have a potential for a higher return on invested capital, have a tendency to pay less in dividends. And finally, size is a really large factor as well. And that's kind of a mix of profitability and investment opportunities, but tends to be more related to the profitability. So I'm going to flip over to another paper that I have posted here. Where to go? There we go. Disappearing dividends, right? So this is one of the other papers that I have posted in class. Right? So paper looks over time. So these are the authors that created that data set looking at the overall market rate of return and giving averages for the risk-free rate. All right, so over time, right, we see that there's a large jump in the number of public firms listed in the United States. Across that time, we also see that there's an increase in the number of companies that don't pay dividends. And there's also a decrease in the number of dividend payers. So this gets us a better idea of what's going on here, right? So for a very long time period, it was traditional and almost a standard for companies to be paying dividends, right? Other than the Great Depression here in the late 20s, early 30s, it was the standard practice for companies to be paying out dividends. Then we saw that switch, right? Roughly around the 70s. This is when non-payers really took off and became a higher proportion of publicly listed companies. Right? And basically what they find is that it's a mix of those three things, the profitability, investment opportunities, and size of the companies that really help determine this change in the trend. Right? Basically over time, what we've seen is a decrease in the number of companies with positive earnings, right? Profitability is one of the main determinants, right? If you have profitable projects, you're going to be generating some excess cash. So everything else equal, there's going to be additional opportunity to pay out those dividends. Right? And interestingly, most of the companies that, the really high growth companies that are pretty popular on listed exchanges are listed on the NASDAQ. And as we can see here, right, the proportion of companies that are listed on the NASDAQ relative to the New York Stock Exchange, which has more stringent profitability and size requirement, the proportion of companies listed on the NASDAQ has absolutely plummeted. Right, so over time, we've seen that there has been an increase in the number of firms outstanding, a nominal decrease in the number of dividend payers, and a relative decrease in the number of dividend payers. Right, and this is largely attributable to companies being less profitable, more smaller companies being listed, and also more of those small companies largely relying on growth opportunities, right? In other words, investment opportunities. So basically, it looks like companies are engaging a little bit more. They're a little bit more sensitive to this relationship between the return on invested capital relative to the WACC. If companies have investment opportunities, if they have profitable investment opportunities in particular, everything else equal, it's better to avoid paying the dividends and reinvest within the firm. Right. Dividends are, again, right, just looking at the Excel example we were looking at, dividends are important. And we can also see that by looking at how markets react to information about dividends. So this is looking at the abnormal returns for initial dividend announcement, in other words, dividend initiation. So before this time period, the company did not pay dividends. They announced that they're going to be paying dividends, and this is the abnormal return after that. So when we say abnormal return, basically what it means is it's adjusted for market return. So what sort of return in excess of the overall market is observed over here? And we see that on the announcement day in this event study, there's the positive increase, right? There's a 5 percentage point increase, roughly 5 percentage point increase in the company's value at this time. All right, so dividends are important. And there's a few reasons that this is suspected. One is the signaling hypothesis, right? Companies can't pay dividends if they don't have the cash flows to support them. Right, so when companies start paying dividends, it's a suggestion that maybe the company has additional value-adding opportunities available to them. Also, the amount of dividends being paid out matters as well. Right, so when dividends increase, so dividends are already being paid by the company, but they announce that they're going to be increasing those dividends, there's a positive return around that time period as well. And we also find a somewhat similar reaction for share repurchases. Not as strong of a reaction, but there is still a positive reaction. So it's suggested that between the differences between the share repurchase and the dividends, because there is a much stronger increase with the announcement of dividends being paid out, that there's a lot of value in the signal that the companies have value-adding projects sufficient to fund the cash outflow of these dividends.
Dr. Jensen,
Yes.
so when a company announces like a stock split, doesn't it also cause it to increase for a moment?
It does, but that's basically a slice of the pie problem. So when you're dealing with stock splits,
Mhm.
basically what's going on is you're changing oh, I can't remember it now. I lost my train of thought. Let me double check that. So what was your question again?
No, I was just saying, since we're talking about the increase for the abnormal return, I was saying when a company announces a stock split, doesn't it cause an abnormal return also? It has like a heightened.
Can't remember off the top of my head. I've got to look that up.
Okay.
That is a really good question though. Yeah, I've got to look it up just to double check.
Okay.
So interesting thing with dividend policy is kind of the different incentives that are available. Right. So we have the investors of the firm and then the firm itself and the people operating within that firm. Right. So investors have different tax rates on their income. Right. And dividends are taxable investment income that are being paid out to investors. So everything else equal, if we're dealing with an investor base with high tax rates, then everything else equal, they're going to prefer that the company reinvest within itself, because this is that double taxation issue that you sometimes hear about with investment. If companies pay out dividends, they're being taxed on the profits from which dividends come out of. And then also the investors themselves are being taxed on those dividends being paid out. Right. So everything else equal, high tax investors are going to prefer that those dividends, rather than being paid out to investors, are retained within the firm, because those high tax investors have a higher marginal tax rate. So that double taxation is going to hit them a little bit harder. On the flip side, low tax investors, they don't have that same incentive. Then companies themselves, if they have significant investment opportunities, as we saw in the Excel example, as we've seen in the trends on companies over time, if companies have investment opportunities, they're going to be better off reinvesting in themselves. And on the flip side, if they don't have investment opportunities, this could be better off to pay out. And then there's also individual preferences, right? So do people prefer dividends being paid out, or do they prefer capital gain? Right? That's one of those quirky sort of individual investor preferences that seems to have stuck around for a long time, right? So theoretically, investors can get money out of their stock investments just by selling their shares, right? There is technically no need for companies to be paying out dividends to investors for them to get capital, because they can just close their positions out, or portions of their positions. But there is this thought, there is this mindset that people have that if companies just pay out dividends, that can be a source of income without closing the position in the company. So they might have a preference for companies paying out dividends. So there are alternatives to dividends. So typically dividends are paid out in cash. It is also possible to offer stock dividends. So if you have one share stock, you'll be offered some fraction of a share in the company. As you mentioned, stock splits are another option as well, right? When a company splits the stock, basically what's going on is they keep the overall structure of the company pretty similar, but they increase the number of shares outstanding, and that reduced price in many ways can increase demand. I got to double check, but I think that increase in demand is part of the motivation for the increase in share value. So for example, if you look at a company like Berkshire A stock, the value of those shares is prohibitively large, and the trading volume in those shares is relatively small because of how costly those shares are. Right, so part of the motivation for stock splits is to make the company's stocks a little bit easier for individual investors to purchase. And as you increase the investor base in the short run, it can increase demand for the company's shares. And finally, there's going to be share repurchases. This is the one that I started explaining for stock splits and got them mixed up. But share repurchase basically reduces the number of shares outstanding. And in doing so, it just reduces the amount of shares that cash flow is being allocated to. Right, so this is the slice of the pie sort of situation. So if the company as a whole generates a given amount of cash flow, the fewer shares that cash flow is split between, the more value is going to each share. Right, so there are alternatives to dividends, but sometimes, right, individuals have certain preferences that might lead to them wanting dividends being paid out. But a difficult thing with dividends is that they're relatively sticky over time. Right, companies or markets react very strongly and very harshly to decreases in dividends being paid out or cancellations of dividends being paid out, because on the opposite end of announcing that the company is going to be paying dividends, canceling dividends is often interpreted as saying that the company is no longer confident in their future cash flows, that they're no longer confident in their investment opportunities to generate the returns that they were expecting. So there's an ongoing debate on whether or not companies should be issuing dividends relative to repurchases, right? And there's some pros and cons between them. So on the one hand, repurchases are very flexible, right? So the flexibility of repurchases is really great because companies can do that when they just happen to have a one-off excess cash here and they're not necessarily sure what to do with that excess cash. Right, so if they don't have any readily available investment opportunities and they're sitting on a large pile of cash, sometimes investors would just prefer it being paid out, possibly in the form of repurchase. Repurchases can also help offset dilution, right? Over time, companies might be issuing shares to executives based on some contractual agreements and as part of their compensation policy, right? So in order to help offset that dilution and try to get more cash flow allocated to each share in the company, one thing they can do is to issue those repurchases. Another nice thing with repurchases, embedded basically in the flexibility really, is the investment opportunities that are available with it. When companies commit to paying dividends, they really are telling markets that we're going to stick with this dividend and we're going to be paying out to investors regularly. So while investors might enjoy that regular cash flow, it can cause a hardship to companies, and that it can be very difficult for them to be flexible in jumping on their investment opportunities, right? So if a company, for example, happens to think that one of their competitors is extremely undervalued in the market, and this might be a great opportunity to basically get rid of a competitor and also expand their hold on an industry, then they might have an opportunity to make an investment or something like that. But dividends in and of themselves are prohibitive towards investment because they're basically taking a company's profits and already determining that those are going to be paid out in the form of dividends. Yes, you had a question? Danny? Yes, sir. And like we were talking about before, we also have taxes as an issue as well. Right? The problem with this is taxes are very idiosyncratic. They're based on individual investors. Right? So because they're based on individual investors, it's hard to know what exactly to do. The interesting thing with dividends, and this is going to be one of the last discussion posts that I'm going to have a paper for you all to read. And it's a very, very short paper. It's basically just talking about we, in many ways, don't really know what the best decision is in regards to dividends. Right? Because of the investment issues with dedicating a company's profits to paying out dividends, that's going to cause issues for the company over the long run, right? If they have investment opportunities that they're foregoing, right? We know opportunity cost, that's reducing the value of the firm. Also, because there's such a wide investor tax base, right? Early on in people's careers, typically they tend to be lower income, lower tax, and over time tend to generate more income and end up paying more in taxes. Typical life cycle of tax payments, right? There's going to be a myriad amount of preferences for that taxation. Lower tax might prefer the dividends. It gives them a little bit of spending money. Higher tax prefer not, because they're really feeling those double taxes taking effect. Right, so at the end of the day, there's a lot of trade-offs to consider. Companies would be best off focusing just on the return on invested capital versus the discount rate. If companies made the decision on paying dividends solely based on that, they'd be much better off, because, right, if they were very forward with the market and saying, look, we're going to be paying some cash dividends, this might be a one-time payout thing, but it's more important that we focus on investment opportunities as they come about. Unfortunately, that's not something that we've really seen taken effect in public companies. Right, if companies were a lot more flexible with their dividends, right? If rather than having a stream of dividends, they say we're having a one-off dividend payment rather than a one-off repurchase occur, right? That would give companies the flexibility that they need. But unfortunately, that's not a change that we've seen come about in public companies yet. All right. This is going to be a good place for a 10-minute break. Just going to pause here for a couple minutes, and I'll see y'all in 7:20. Yeah. Right, so key points coming out of this are where the value is coming from investment policy relative to financing policy. Right? Investment policy, as we've been kind of stressing throughout the term, is really where the value is being generated over the long run. And that's coming from finding value-adding projects and investing in them and getting rid of value-destroying projects. Financing policy offers ways to increase value, but they're relatively small over time. And there's two ways that we can look at managing a company's capital structure, primarily through the weighted average cost of capital. And those two ways of dealing with that are the pecking order and Modigliani and Miller. With the pecking order, basically what we're seeing is that companies want to exhaust the cheapest funds first and then move on to the more expensive sources of capital. Right? And we do see that companies tend to fund themselves most internally. So internal funds are going to make up the majority. Between 2/3 to 75% of the company's capital is going to come internally. And from there, they're going to exhaust the various sources of external capital available to them. With the Modigliani and Miller theorem, basically what's going on is, in order to minimize the WACC, we have to balance the debt and equity ratio of the firm. But overall, not much value is going to change, because the WACC, this U-shaped WACC, is going to be relatively flat because of the trade-offs between the increased cost of capital and the lower cost of the net of tax debt. So over the long run, managing finances can improve the company's value by minimizing the cost of capital being applied to the cash flows the company is generating. But overall, those changes in values are relatively small. Right, so key takeaways. Investment policy is generating the most value. That's why we spent more time focused on not only just time value of money, but net present value and the different sources of, or the different types of capital budgeting tools available, as well as calculating the free cash flows of the company and putting that into net present value. Any other questions? All right, so y'all's project and presentation is going to be due next week. So I want to take some time to go over any questions that you might have about the project at this point.
Do we still need to do a PowerPoint presentation also?
As part of your recording. Yes.
Okay.
Any other questions? As you're going through the valuation, always remember the three long run important inputs: cash flows, discount rates, growth rates. Those are going to be the cornerstones for the inputs you're going to be using in your valuation. So make sure that you use valuable resources. We have some posted in D2L, right? The company's financial statements, management discussion and analysis. That's going to give you a lot of information about right, the potential value the company is going to be generating, as well as some potential risks available to the company. We have resources to get the market rate of return and risk-free rate. You need those for the discount rate. And the growth rate itself can come straight from the company's financial statements, from MD&A, from analyst discussion. All of that is readily available through Capital IQ. So use the resources that's available to you and try to build up an argument for why you think these inputs to your valuation are relevant, and to justify the decision you're making with your valuation.
I have a question regarding the final exam.
Okay.
Is that gonna be something that's timed, that we are gonna be taking, like, sit down style?
Yes. So it is going to be a timed exam. We're going to be going over the review next week. So we'll talk about it a little bit more then, but it is going to be timed. Let me just double check the window. Yeah, so you're going to have all day to be able to work on it though. But once you start it, you are going to have to finish it.
Okay, thank you.
And again, the exam is going to be qualitative. The problem set and the valuation project are the quantitative portions of the course.
Does that mean like discussion type questions?
Yes.
I have a question about the discussion post. Did we have until the end of the day to do that, or did it end like halfway through the day? Because I never got to do a response because it was closed.
Oh, which discussion?
The one that was due on the 19th.
Oh, geez. Yeah. I'll reopen that up. I thought I had that midnight. For some reason, it was set at the time. I think I opened it 1:45. Yeah, that isn't right. Shoot. I'll reopen that right now. I'll extend it to be due by end of day tomorrow.
Thank you.
That was my mistake. Thank you for pointing that out.
I mean, I did my own post. I just didn't know we have to respond to other people too, right?
You're not required to respond to other people,
Oh,
but I
okay.
do highly recommend you look through other people's responses, just to get an idea on, yeah, just to get an idea. Use it as a study guide.
Copy. Appreciate it.
You might want to look at the one due tomorrow too, because I think it shuts off at 2:03.
Yep, I just saw that as well. Yeah, I'll be editing the turn in. Yes, thank you for pointing that out. All right, I'm also going to have one more discussion posted. It's another short paper. I think it's 6 or 7 pages long. Any other questions?
I have a general question about the tax rate and affairs and acquisition. How does that typically affect the company's tax rate?
With an acquisition?
Mm-hmm.
Just talking about general taxable income. As far as I know, I don't think it necessarily would. Definitely more of an accountant's question, right?
Okay.
But in general, income is based on, or the tax a company is going to be charged is based on their taxable income,
Mm-hmm.
which stems from, right, their income statement items, revenue, net, their costs, and all that.
Okay.
So only to the extent that the acquisition is changing their revenue, or I should say net of cost revenue that results in taxable income, then that's gonna be the effect. There is likely some direct taxes related to purchase or sale itself. I don't remember what those rules are though.
I just noticed on the evaluation that we're doing that tax rate was pretty high in capital IQ, so I was trying to figure out why that was, but
So, yeah, and also remember that there are potentially 3 tax regimes you're looking at in this valuation. So that's also why it's important to adjust that and change it to a more forward-looking tax rate that is more reasonable for the company, right? Because tax rates are lower than they were at the start of the valuation period. Great question. All right, anything else?
Quick question. Sorry if you've gone over this. Was there a time limit on how long our presentation needs to be?
10 minutes at the most, 5 to 10 minutes.
Okay, thank you.
All right, so please come ready with questions next week. I'll have my own thing to say a little bit about, but the amount of detail I go in with the review is just going to be based on questions you'll have about topics in the exam itself. So be ready with that. If you have any questions about the project, please post them on D2L. Really appreciate questions on there. A lot of you sent me the same questions on the problem set. At the end of it, I was ending up just copy and paste my response to some of you. Right, when someone's having an issue with something, you're probably not alone. So posting things on the discussion boards can be helpful to other people that are having a difficult time with something. All right.
When will we be able to see like our grade for the problem set?
This weekend I'll be working on grading stuff, so hopefully by Monday I'll have grades done for all currently turned in assignments.
can we ask you a question about the problem set right now, or should we wait?
Yeah, sure.
So I could not figure out on the risk and return, the risk to reward ratio question, and why the risk to reward ratio did not change for that one problem set. It says in your own words. Right?
Yep. Okay, so how are we calculating the expected return?
So the risk-free rate plus beta.
Yep.
Risk-free rate plus a beta.
Almost there.
Minus the market
times the market risk premium.
Times the market risk premium. Okay.
Yeah, right. So this was another little trick question there, but whenever we have a model and we put inputs to that model is basically giving us the output. So in the case of CAPM, basically we have the same slope across the board, which is the market risk premium. So if we're applying the same market risk premium to all of these different assets, we're forced to end up with the same reward to risk ratio. So in other words, if we're in a CAPM world and we use CAPM to project the expected returns, we're going to have the same reward to risk ratio across the board. The interesting thing is when we compare that reward to risk ratio in practice, right? Because we know CAPM doesn't do a great job explaining returns. So in reality, we see reward to risk ratios that vary much differently relative to if returns could actually be predicted with CAPM.
Okay, it just threw me off because the betas were different and the expected market return were different. So I was like,
yeah, so well, that's kind of the key thing there, right? So with CAPM, the expected return increases with beta.
Mhm.
So we should expect to see different betas because different assets have different risk,
Right.
but they all have the same reward to risk ratio if we're using CAPM. And that reward to risk ratio is basically the slope of the line we're looking at on the security market line.
Okay, that'll sink in.
Let me double check. I think one of the slides had that graph in it. Yes, there we go. So as beta increases, the expected return is going to increase as well. So we should see different expected returns. We should see different betas across asset class. What's not changing across them is they're basically just on the same slope here. Right. So if we predict returns with CAPM, then we're necessarily just going to find them all on the same slope here. Any other questions about the problem set?
Can you rephrase that statement in a different way? Because it's not clicking to me either.
Sure. Let me think. All right, so with CAPM, the basic premise is that as we increase risk, beta, we're increasing the expected return, right? So it's that, you don't take any risks, you don't get any rewards sort of idea, basically. This is just formalizing that idea. As we increase the riskiness of an asset, we're increasing the expected return. But that's going to be based on what exactly the beta is and what the market risk premium is. Right? So if we're predicting returns with CAPM, the betas are going to change. The expected returns are going to change, but they're all going to fall on this line. So in other words, the reward to risk ratio, the slope divided by their beta is going to be the same. Did that make a little bit more sense?
I guess. So
No,
are
I
they
guess.
like offsetting each other? I mean, okay, can you
So-
go to like the problem and then explain it? Maybe that'll.
All right. So we're calculating the expected return using CAPM. CAPM equal to the risk-free rate plus beta times market risk premium. Or what if I have? Turn on market minus risk-free. So we get our risk-free rate plus our beta times our market risk premium. This is going to get us our expected return. So what's going on here, right? One other thing we can do is resort those by beta. Right? Under CAPM, we should expect that as risk is increasing, so is the expected return. And that's exactly what we see here. When we start off with no risk, we're getting the risk-free rate of return. Right? So in other words, I don't know why I'm getting this error where PowerPoint won't pop up. I click on the minimized version of it. But anyway, when we're at the risk-free rate, right, we're basically at the intercept, where beta is equal to 0. we're going through the y-axis. Right, so here, where there is no risk, all we have is the risk-free rate. And from here, we're just adding on risk. And whenever we add on risk, we're increasing the expected return. But that increase in expected return is increasing at the same rate because of the market risk premium. Right, so if we were to put this on a slope, we get the security market line. This is exactly what we were looking at in the PowerPoint. We have the amount of risk on the x-axis and the expected return on the y. So as risk increases, the expected return increases along with it. And that's what we're seeing here is basically just the security market line in action. Right, so because the slope is the same, the reward to risk ratio is going to be the same for all these. In other words, we do have different expected returns, but those expected returns are proportional to the amount of risk. Right, so while these returns look a little bit jumpy, it's only because right when we sort it and then make this graph relating the beta to the expected return, we now see this consistent relationship going up. Right, so the reward to risk ratio for each one of these assets is going to be the same because all these assets are falling on this line. So in other words, they have the same slope.
Okay, I got
Right.
it. I get it. Cool.
Any other questions about the problem set? Are there any problems that you'd like me to work out on it?
I just have a question on the very last problem on WAC. Did you get 8.55%?
The very last question.
Yeah, it's on the WAC tab all the way at the bottom.
I don't remember what the answer is. I did get a lot of questions about this. If you'd like, we can go through and calculate it. Shouldn't take too long. All right, so all right, so starting with preferred $150,000 dividend. So in other words, this is a fixed perpetuity. If it's paying out $150,000 dividend every year, that's a fixed perpetuity. The value of that is just the amount being paid out divided by the discount rate. Gets us our price. Market value for any asset is the value of the individual assets times the number of assets outstanding. Common equity. Same market value. All right, so in other words, we're starting backwards here. So the market value of common equity is just going to be equal to the overall value of preferred. All right, and working backwards, right? So we got the market value by taking the price times the shares. If we have the market value in the number of shares, then we just divide market value by the number of shares. Brings us to the price of $7.50. All right, what information do we have? It will issue a 50-cent dividend. That's going to grow at 2% a year. So we have our price and growth model. Let me see if I can remember this. So it's going to be returns equal to dividend divided by price plus growth. Yeah. So we have dividend divided by price plus the growth rate.
That's actually the part I had problems with. Wouldn't it be dividend of year one since it's a growing dividend?
So it's already giving you the next period's dividend, right? So you need the right? When you're dealing with the growth rate, that's going to be the price today,
Okay,
right? So if it is going to issue, then that means that 50-cent dividend is going to be taking place in the next year,
gotcha. All right.
right? So this is where timing is really important, right? So if you just adjust the timing of a cash flow by a single year, you're going to be changing the value of the asset and therefore the cost of equity associated with it as well. So we have our costs of equity. Now our cost of debt is just going to be the base rate plus the premium to it. All right, and now we can go on, put this all together to get the WACC. So we'll get the market value of debt plus the market value of equities. So preferred divided by always good just to double check that they add up to 1. If not, then there was a mistake. We have everything we need now to calculate the WACC. So we take our weight of preferred and multiply it by the cost of preferred, the weight of common times the cost of common, and the weight of debt times the net of tax cost of debt. Get us the WACC of 9.5%.
Do you not subtract tax instead of add?
Oh, yes, thank you. Yeah, the 8.5% instead of 30. Good catch there.
Dr. Jansen,
Yes.
could you go to that B95 formula again? Uh, so I think earlier somebody did mention this, but why was it that you don't add the next year's growth to the dividends on B96 again?
Because the dividend it's already based on the dividend that's going to be issued. Right. So it's basically the timing of the dividend. So it will issue a 50-cent dividend next year. Right. So this 50-cent dividend is already the future cash flow.
Okay. All right. Thanks.
So
read
that's the
carefully.
timing difference.
Yeah, that one got me too. So
It's a tough
it
question.
it comes out to 8.55 if you add the extra year in there.
Yeah.
But yeah, just little differences in timing can lead to drastic differences in results. Any other questions?
Could you go through the second question on bond valuation?
This one?
Mhm.
Yeah. All right, so let's see. 2 semi-annual. All right, so we're getting prices pounded semi-annually. Your bond, not paper bonds. Check these. Right. fixed reference. Longer, this is the right term to maturity effect on the price sensitivity of longer term bonds versus shorter term bonds. So we'll always see this being the case where longer time to maturity bonds are going to be much more sensitive to changes in interest rates. Right, so both bonds are experiencing the same change in the interest rate, but we see that the price changes on the longer term bond are much more drastic relative to the shorter term bond. Any other questions? All right. Well, if there's anything else, I hope you all have a great night. Please post any questions you might have about really anything about the end of the class through on the discussion boards. Really helpful for the people to see those questions as well.
And you're going to put another discussion paper for us to respond to, right?
Yes. Yep. And I'll make sure to get a correct time for that to be turned in. Yeah. I'll update that. The first discussion, I'll reopen that for tomorrow as well. But don't forget the cash flow growth and stock returns one. Anything else? All right. Hope you all have a good night and best of luck with the project. Look forward to seeing your presentations.
Thank you.
Thank you.
Have a good night, Dr. Vincent.
Thanks.
Have a good night.